What if I told you that Warren Buffett, the man who famously said he doesn't understand oil businesses enough to predict them, quietly turned around and spent over $13 billion buying one single oil company? Not slowly. Not cautiously. Aggressively. In some weeks, Berkshire Hathaway was buying Occidental Petroleum stock every single day, like he couldn't get enough of it. So what did Buffett see that Wall Street missed? What changed his mind? And most importantly, what does this tell us about how the smartest investor alive thinks about money? Stay with me, because by the end of this video, you're going to see this trade in a completely different light. First, let's quickly understand what Occidental Petroleum actually is, because it's not just another oil company. Oxy, as it's commonly known, is one of the largest oil producers in the United States, with massive operations in the Permian Basin, the richest oil-producing region in the country, stretching across West Texas and New Mexico. But here's what makes Oxy different from companies like ExxonMobil or Chevron. Oxy is a pure-play energy company. That means it lives and dies by oil prices. There's no massive refining division to cushion the blow. No diversified chemical empire. When oil goes up, Oxy absolutely prints money. When oil crashes, Oxy bleeds. And that volatile nature is exactly why most conservative investors historically avoided it. So when Berkshire Hathaway started aggressively accumulating Oxy stock in early 2022, people were confused. Let's talk about the scale of this, because it's genuinely jaw-dropping. Buffett began buying Oxy in February 2022, and he didn't stop. Within just a few weeks, Berkshire had crossed 10% ownership. Then 15%. Then 20%. By mid-2022, the SEC had granted Berkshire permission to own up to 50% of Occidental, which is almost unheard of for a passive investment. At its peak, Berkshire's position in Oxy was worth over $13 billion, making it one of the top holdings in the entire Berkshire portfolio, sitting alongside Apple, Bank of America, and Coca-Cola. Buffett also holds $10 billion in Oxy preferred stock, a deal he structured back in 2019 when he helped finance Oxy's acquisition of Anadarko Petroleum. That preferred stock pays Berkshire an 8% annual dividend, which amounts to roughly $800 million per year in guaranteed income, rain or shine, regardless of oil prices. Let that sink in. Before Buffett even bought a single share of common stock, he was already collecting $800 million a year from Oxy. Now let's get into the why, and this is where it gets really interesting. Buffett has always said he wants to buy great businesses at fair prices. And he sees the Permian Basin as one of the greatest geological assets on planet Earth. The shale revolution in the United States transformed American energy independence, and the Permian is the crown jewel of that revolution. Oxy holds some of the most productive and lowest cost acreage in the entire Permian Basin. What does that mean practically? It means Oxy can profitably pump oil even when prices are relatively low, around $40 per barrel, while competitors are losing money. When oil is at $70, $80, $90 a barrel, Oxy is generating extraordinary free cash flow. Buffett recognized that owning Oxy is essentially owning a piece of American energy infrastructure, a real, physical, irreplaceable asset that produces cash for decades. Here's the second piece of the puzzle, and it's all about macroeconomics. When Buffett started buying Oxy in early 2022, inflation was roaring. The Federal Reserve was about to embark on the most aggressive interest rate hiking cycle in 40 years. Buffett has said repeatedly that inflation is the investor's worst enemy. It silently destroys the value of cash and bonds. So what's the best hedge against inflation? Hard assets. Real things. Oil in the ground. Physical commodities that naturally rise in price as the dollar weakens. Oxy, sitting on billions of barrels of oil reserves, is essentially a leveraged bet on energy prices, and energy prices tend to outperform during inflationary periods. Buffett wasn't just buying a stock. He was buying an inflation-proof asset at a time when most investors were still holding overvalued tech stocks and hoping the Fed would blink. He didn't blink. Buffett was right. Now, here's a reason most people completely overlook, and it might be the most important one. Warren Buffett loves Vicki Hollub. Hollub is Occidental CEO, and Buffett has publicly praised her multiple times. He's called her extraordinary, and said that after watching her presentation at a conference in 2022, he immediately started buying the stock. Why? Because Hollub had done something rare in the energy industry. She had transformed Oxy's capital allocation strategy. After the painful debt-fueled Anadarko acquisition nearly broke the company during the COVID crash of 2020, Hollub made a promise: Oxy would never again overextend itself on debt. Under her leadership, Oxy committed to paying down debt aggressively, returning massive capital to shareholders through buybacks and dividends, keeping operating costs lean and efficient. This is pure Buffett language. He didn't just buy a commodity business, he bought a well-run commodity business led by a CEO who thinks like an owner. That combination? Extremely rare. Here's the most contrarian part of Buffett's thinking, and it's what separates him from the crowd. In 2022, the mainstream narrative was, oil is dying. Renewables are taking over. ESG investing is the future. And Buffett said, essentially, not so fast. He recognized what he calls the energy transition paradox. Yes, the world is moving toward renewables. But that transition will take decades, and during those decades, global oil demand isn't going to collapse. It's going to remain strong, especially as developing economies in Asia and Africa continue to industrialize and modernize. In the short to medium term, think 5 to 15 years, oil is still the backbone of global energy. Meanwhile, underinvestment in new oil production over the past decade, thanks to ESG pressure and low prices, means supply is constrained. Less investment in drilling equals less future supply. Less supply plus sustained demand equals higher prices for longer. Buffett saw this structural supply-demand imbalance and positioned Berkshire right in the middle of it. So what's the bigger lesson here? This Oxy investment is a masterclass in Buffett's core investing principles. 1. Be greedy when others are fearful. When ESG trends were pushing investors away from oil, Buffett leaned in. 2. Understand the business economics deeply. He didn't just look at Oxy's stock price, he analyzed break-even costs, reserve quality, cash flow generation, debt structure. 3. Back exceptional management. He trusted Vicki Hollub's vision and capital discipline. 4. Think in decades, not quarters. Buffett isn't trading around oil prices. He's making a long-term bet on energy's indispensable role in the global economy. 5. Structure deals with asymmetric upside. The preferred stock deal means Berkshire gets paid no matter what, $800 million a year, while also participating in the equity upside. That's not just smart investing. That's genius deal architecture. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." His Occidental Petroleum investment isn't a hot take or a lucky bet. It's a carefully constructed position built on hard assets, exceptional management, macro timing, and structural deal terms that almost guarantee a positive outcome. Whether oil prices go up or down in the short term, Berkshire is protected. And if oil stays strong? This becomes one of the greatest trades of Buffett's final era. If this video gave you a new way to think about value investing, drop a like, share it with someone who follows markets, and subscribe for more deep dives into how the world's greatest investors actually think. I'll see you in the next one.